Welcome to Hart Energy and Stratas Advisors What's Affecting Oil Prices for the week of August 7th, 2017.
In the week since our last edition, Brent crude fell 13 cents week close to close, generally in line with our expectations. Brent will likely average $52 this week. We also expect the Brent WTI differential to trade around $2.50 with respect to the September contract. In terms of inventories, we expect U.S. crude draws will be around 1 to 2 million barrels as runs steady near a seasonal peak. Geopolitics, as it relates to oil, remains fairly uneventful and therefore unlikely to play a large part in oil prices this week, barring a surprise development. While the ongoing situation in Venezuela bears watching, so far the White House has declined to pass any industry-wide sanctions that would have an immediate impact on oil. Given the substantial impact on prices from fundamentals and sentiment, the dollar as well as the U.S. dollar-euro exchange rate are still not as impactful as they've previously been. The dollar saw some support from a strong jobs report last week, and it is a key technical level as well. We expect the dollar to remain a neutral factor in the week ahead. Trader sentiment will be a neutral factor as Brent continues to hover just below overbought territory. Traders will likely remain sensitive to any negative fundamental data, especially in the IEA report out on Friday. NYMEX and ICE both reported that WTI managed money net longs increased last week, and ICE Brent managed money net longs also increased. For WTI, this improvement was driven by increased long positions, while the improvement in ICE Brent was caused more so by a drop in shorts. Last week, the number of operating oil rigs in the U.S. decreased by 1, according to the weekly report from Baker Hughes. This week's OPEC and IEA monthly oil reports are likely to confirm initial estimates of rising OPEC production, which will weigh on prices in the back half of the week. Markets will also be closely watching the results of a joint OPEC-non-OPEC meeting to discuss the current quotas and overproduction. Demand remains a bright spot supporting crude prices. In the U.S., gasoline demand is above the 5-year max, and inventories have been steadily falling. Distillate demand is also well above the 5-year range. ARA total product stocks fell, with only gasoline building slightly and all other products seeing draws. Margins fell almost across the board last week, but remain elevated enough to incentivize runs. U.S. crude inputs rose last week and will likely grow slightly this week, supporting crude demand. In Western Europe, cracks retreated sharply but are nowhere near the year's lows. Cracks are also down in Asia after reaching new highs last week.
This weekly report is an excerpt from our short-term price outlook service analysis. For more information, please contact us.
To stay up to date on the most recent Hart Energy videos, subscribe to our YouTube channel by clicking here.